Bluestone makes investment loans simple with competitive interest rates. Borrow up to 85% of the value of your investment property without paying lender's mortgage insurance, and no cap on existing investment portfolio size. Plus, personal Bluestone support from application to settlement. So don't wait to unlock your future. Bluestone, award-winning home loan solutions. Find out more at bluestone.com.au/investors. Lending criteria, T's and C's and fees apply. Credit provided by Permanent Custodians Limited, Australian Credit Licence 390183.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good everyone, how you going? Phil Tarrant here, host of the Smart Property Investment Show. Hope you're well. Hope you've been connected in with Smart Property Investment. It's been going off the charts the last couple of weeks. Something's happening in property. I don't know what. I'm trying to understand it myself, but every single person I speak to in property investment is talking about this boom market. But I'm starting to get some conflicting opinions towards it. One being that, yes, there has been rapid growth, but the speed of growth is starting to wane, and there's a lot of reasons why that is taking place. And then also certain markets in Australia are starting to not perform compared to others. So there's 300-ish type geographic areas which sort of give us a footprint for matching and monitoring property in Australia. Some of them have really come off quite a lot, and had a really good discussion just the other day with some property data people. You can go and check it out on smartpropertyinvestment.com. That gave a lot of narrative into it, but everyone's on it right now. Property investment is the flavour of the month. I can't go anywhere without anyone asking me what's going on with property. And my default position is I don't know a lot about it, but I know a lot of people who do know a lot about it. And today I've brought a couple of them into the studio to have a chat with me to make some sense of real world, on the ground realities of buying property in this market. Now, you can only buy effectively in property if you know what's going on in your portfolio, and we use a great little tool here at Smart Property Investment. It's a spreadsheet that over many years we've glued together and refined and enhanced, that gives us a visibility at any given time of our portfolio, how it's performing at a P&L level, balance sheet level, debt level, yield level, and we're now making that available to our listeners. So all you need to do is go to smartpropertyinvestment.com.au. You'll see a big button that says download the Smart Property Investment Portfolio Spreadsheet. We've done this in conjunction with our friends at Atlas Property Group. Go and check it out. It's really easy. Just chuck in your email address and we'll email you through this spreadsheet. It's a great tool. It's a great resource. If you've got any questions about it at all, you can always contact the team, editor at smartpropertyinvestment.com.au. We can chat through it. If there's any terms in that sheet that you're unfamiliar with, or how we've looked to define some of the parameters in our portfolio, there's heaps of information on smartpropertyinvestment.com.au. There's a glossary, there's everything. They'll tell you what it all means. But let's move on. Today's podcast, in the studio with me, back by semi-popular demand, Paul Glossop. He's the director of Pure Property Investment. He's dragged in one of his clients who he's victims who he's just, from what I understand, got a reasonable deal for. So I wanted to break down this particular scenario, how it's worked, how it's gone right, how it's potentially gone wrong, what these guys would have done differently, and just how good this is. And, you know, this is within the sort of confines of the ideas that in any market there is opportunities, even though you may be fatigued, even though you may feel as though you can't get a run or get a win in this moment because every single person is buying property. There's still some hot deals out there. There's some gems in there. Paul Glossop, Alex Whitlock, he's also the other side of the Smart Property Investment portfolio. This is him dabbling himself, creating wealth outside of that portfolio as well. Gentlemen, how are you? You good?
Very well.
Good, thanks, Phil.
One of your longest
preambles and...
No, it's actually short these days.
Really?
Yeah.
What are we at? 7 minutes?
No, we started off early. So,
gotcha.
Hey, what's your thoughts on, Paul, before we get going, giving some context to the market and how everything's sort of bubbling along? I see Australia has retained its AAA rating, has been uplifted from a sort of negative position to stable. And now I think we're only 10 countries in the world with Standard & Poor's that have a AAA rating, and I think we're one of 9 countries in the world across the 3 different rating agencies that have a AAA rating. What does all this mean for property, mate?
You flexing your intellect there.
You like that?
You're on top of the data. You say with the face too. If anyone could see, it's the deadpan face to say, see what I know.
Well, mate, it's all locked up in there somewhere.
No, I like it.
Yeah.
It's really interesting because there's a few other things that are sort of coinciding at the moment. And I only saw the most livable city report came out yesterday. Radelaide.
Yeah.
Depending on who's there, not get out of Townsville, but Radelaide. But anyone who's listening and is a rugby league fan, they would have had a little bit of an affinity for that as well.
Yes.
But also there was 4 of our major capital cities in that report in the top 10. You had Perth, you had Adelaide, you had Melbourne, and I believe you also had Hobart in there.
You did.
Interesting. Not necessarily new, but if you looked at the spread of the G7s or essentially any westernised countries, we had by far the biggest spread of countries in there as most livable, but we're still expensive. So you've also got to take that into consideration. And then the other things which I guess I'd note to this AAA rating as well as where the sentiment is in the property market is May CoreLogic data came out. As much as April showed that things were starting to slow a bit, May all of a sudden showed that things kind of revved up again in May. So you had Sydney grow for the month at 3%, Brisbane at 2.4%, Darwin at 3.4%, a whole host of markets basically anywhere above 1.5% and more, which is still on track to be probably the fastest and strongest growth year we've had on record. And that's in lieu of now we're seeing all the big fours basically say that fixed rates are increasing. That'll be a common theme for probably the next few months as they set their new benchmarks and new norms. But the reality is that we're still in a very low supply, still in a very strong demand market, with our economy now tipped to be potentially sub 4.5% unemployment rates, potentially sometime by early to mid next year. The economy's strong. It's getting stronger.
And I see lending numbers come out the last couple of days. They're strong as well, irrespective of the fact that there's a whole bunch of people in the market and they can't find property.
First home buyers are getting cooked. That's probably the only real market segment that looks like it's become squeezed. Investors are ramping up and owner-occupiers trading up and down is sort of oscillating, but still very, very strong. So new credit is looking like it's going to go through a boom year.
So, look, I want to get into this investor story, but can you just sort of top-line sentiments for you right now, your attitudes towards investing in property when you consider the competitive nature of property and you intersect that with the sort of financing of property? Is it a good time, mate?
I sat down, you previously, Phil, were also sitting with me on the board of Property Investment Professionals of Australia, and we had an AGM last week, amongst which were a couple of people who are worth noting who've been on your podcast, Steve Waters, Right Property Group. We had Peter Kalisos, who's the chair of PIPA, and quite a number of other industry professionals. And it's really interesting. That AGM was a half-day meeting, basically going through a whole thing. It was all about property finance and property market. Peter himself actually dropped a couple of really key terms, and I believe you'll probably start to see this towards the back end of this year a little bit more, is that we look in all likelihood to be in a similar situation to the roaring 20s post-war. And I think that term of roaring 20s post-COVID is something that looks very likely, at least in the first 3 to 5 years, based on economic positions, based on stimulus, based on cost of money, based on essentially all those main factors we look at. And how does that revert back to property prices and property values? We're only 6 to 8 months into a growth cycle, and I think we all need to take a quick breath to go look at what history does when you go through growth cycles. They typically last anywhere between 1 and in some cases 4 to 5 years. So the reality is that unless there is an existential shock, i.e. something that changes from an economic impact, but also more so from the APRA ASIC side of things and putting some brakes on some certain lending capacities, I don't expect we're going to see a major downward trend anytime soon.
And I want to actually get someone onto the podcast who can talk more informed about this, because I think it's sort of a little bit outside our pay grade. Yep. But I know that the Prime Minister was in Perth and he delivered a speech which was pretty topical and has raised a lot of headlines around some of the security challenges Australia faces to the north, sort of great geopolitical power competition that's taking place right now. And Australia's taking a frontline position. He's in Singapore today and he's moving over to the UK for the G7, and he's trying to rally some support about trying to combat some of these challenges in terms of national security. Is there any real ramification on this on property markets? Because I was reading headlines last night saying, property's going to dip because of this type of thing. Do you have a view on this, or do you think it's appropriate for us to have a view?
It's probably, for me personally, I think when you look at the last 4 to 5 major factors to the economy as far as downward trends or major impacts to the economy, i.e. the last 4 or 5 recessions since the 70s, property over the following 5 years has only increased, in a lot of cases increased exponentially over those years. If we dial back to World War I, World War II, and what the impact to supply, demand was, it was a different world back then. So I think trying to draw parallels to what happens to issues with regards to our own defence and essentially our own borders, it's difficult because we haven't really, I personally don't look at it to say we haven't really experienced it in the modern era. So what does it mean to property prices? I mean, COVID, and we looked at this time last year, the predictions were that we're going to be in a dire position because we hadn't experienced the pandemic for so long, and the world was different when we did. And then the reality of the outcome of it is so different as well. So for me, having a valid opinion, I don't personally.
Yeah. And as I mentioned, I'm just trying to find a good person to come and have a chat about this sort of stuff, because, property operates not in isolation. It's macro and microeconomic factors which are going to change the performance of property in Australia. And that's very much at a macro level. But watch this space. And if you want us to look at that stuff, get in touch, editor at smartpropertyinvestment.com today. Even if you're tuning into this and you have an opinion on this, happy to hear it. Now, let's get into the investor story. Beforehand, let's go to a break. Stay with us. Back in a moment.
Whether you're a seasoned property investor or about to buy your first property, finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Paul Glossop and Alex Whitlock. Alex Whitlock, a client of Pure Property Investment. He's also my business partner and part of the Smart Property Investment portfolio, but this is him dabbling outside of that portfolio. Alexander, are you happy with your most recent purchase?
Phil, I'm never happy with any purchase. You should know that.
Yes, true.
Certainly not when the person who sold me the property stood next to me.
Yes.
Unless it's a boat.
Yeah, look, I have to say that over the 25 odd years that I've purchased properties, I can't think of anything that I've been unhappy with. They've all been good investments. It's probably really been down to my strategy as to whether they've been successful or not. There have been a couple of properties that I've sold too early. I've never hung on to one for too long, I can tell you that, and everyone else tuning in. So looking at this particular opportunity that cropped up, it was impulsive to say the least. I was sat down with our accountant, my accountant, Munzer Khan, who recommended that I should look at going back into the property market. I hadn't invested since 2019. Paul, you operate on my behalf to purchase the Newport apartment.
Yep.
So Munzer said, look, you should really look at buying something. So while I was talking to Munzer, I texted Paul. I said, look, looking to buy something in this particular range, probably in Sydney. Paul texted me straight back and said, I've got something available right now. And before Munzer finished speaking, I'd said, I'll buy it. So it was probably a 15-minute cycle to agree to purchasing the property that Paul got, because I've worked with Paul now 6 years, probably, in terms of purchasing property. We've bought 6 properties together.
Correct.
You bought 6 properties on my behalf. So the trust factor is there with Paul. My confidence in property has been built over 25 years. So although it seems very blasé and glib to people tuning in who maybe haven't bought before, Paul told me the area that the property was located in. I've got a good enough understanding of, sort of demand, certainly in the Sydney area. So the property, just the price range that Paul talked about, to me, sounded like it was on the money and good scope for growth. Short-term, but ultimately long-term growth is what I'm looking for.
So we'll get into the dynamics of the property purchase itself, which is an outcome. But what was the catalyst for the conversation with your accountant to say, oh, Alex, you should add another property to your portfolio? Was there any particular reason why that was the case? Or the strategy behind it?
So my accountant is very familiar with my long-term plans in terms of building wealth. So that's one element. And so he's seen there's an opportunity to further that in this particular sort of property cycle. The second thing is in terms of my income structure, negative gearing is something that favours me. So he's very, very well aware that as a tax benefit alongside a growth opportunity, now is the right time to invest.
Yeah, and that's a really important point for our listeners. And I see it all the time, and Paul, no doubt you see it as well, is that when people start investing in property, they do it for the purpose or the strategy of negative gearing. And let's be absolutely clear, negative gearing is not a strategy. It is an outcome as a property investor. But in the right circumstances, in the right scenarios, negative gearing would be a great enabler as a tool for wealth creation. Speak to your accountant, make sure you're right across how all this works. For buying property for the purpose of negative gearing in isolation doesn't make a lot of sense. But if it's in line with it being a good asset that's going to grow, that adds to your portfolio, it always got some role to play in your portfolio, it's definitely a nice outcome that you can chase to be sure. Now, Paul, let's have a chat through this particular property, and the very small bit of information I know about this deal is that this probably never hit any of the realestate.com type platforms. So it was purely an off-market property. So I want to have a chat about off-market properties as part of this, because everyone talks about off-market properties, and there's a lot of, I reckon, misinformation around off-market properties. And I see now there's platforms being put together for off-market. So as soon as something's on the internet, it's not off-market anymore.
Technically.
So I've got a bit of a beam on bonnet around this, because I think it's this nice term that everyone talks about, off-market. What do you see as off-market?
Yeah, well, if I use that purchase or Alex's purchase as the example, the scenario there was that we had 3 properties with that single owner who was going through a separation, 2 of which were interstate, which we bought as well, and 1 of which was in Sydney. Ultimately, there was no agent involved. There's no sales agent, there's no property manager, there was no one. So we had to essentially coach, and we had to be conscious of the fact that we wanted to make sure that we were paying a price which was what they wanted for the property as opposed to anything else. But ultimately, the definition of off-market was exactly that. We had one person who owned 3 properties, dealing directly with them, and buying 3 of those properties, one of which was for Alex in a Sydney investment, which fit a budget and a strategy. And I was just doing some quick calcs, Alex, and unfortunately Munzerl might not be too happy about it, but the property is probably going to be about cash flow neutral, which is pretty rare for a freestanding house in Sydney.
Well, that's me screwing with my negative gearing then, isn't it? I want my money back.
I'll buy it off you.
So the headline, Gloria, for this is a podcast issue is when negative gearing goes wrong is what you want to talk about it. But no, we laugh at it. So there's pre-market, there's off-market. What other markets are there? That's pretty much it.
Yeah, I mean, there's other ways in which we buy property as well, which I technically define as off-market, where we might have, and I'll give you an example, we've got 4 or 5 properties within what we're looking at within the company at Pure Property Investment right now that I know one of my team members is in Brisbane looking at about 14 properties today and about another 30 over the next 2 days. Almost all of them are unadvertised, and they're not on a portal. They're not on a portal for sale. They might be, and technically a lot of the time they are landlords' properties, and they might have said to their property manager, if you've got a buyer, I might consider selling. From that conversation comes a phone call to us. We then assess the property and we say, yeah, we'd be a buyer at X. That still is the definition of that property is not going to be available for anyone to look at. There might be a Form 6, Form 8 in certain states, depending on what the definition of that property being technically on the market for sale signed, but the property is not advertised and it shouldn't be known by anyone.
And this is, and I've spoken about it for years around one of the benefits of using a buyer's agent is that you actually get to play in this world and you get the breadth of those relationships without, as an investor, having to invest the time, energy, and effort doing it yourself. That said, if you're not using a buyer's agent, you still operate in this market, but you've got to have those connections. So can you give us some sense for with a real estate agent? So a real estate agent might not yet have a specific listing for a property. It's just an organic chat around, hey, if you know anyone that wants this, I could be a seller.
Yeah.
Is that so? So there's no real contract between the vendor and a real estate agent who's got a mandate to sell the property?
Legally,
how does it work?
Most of the time, legally, there has to be an actual contract signed to say, yes, you can then legally actually advertise the property, whether it's just verbally via a text message, via an email, or on a portal.
Yep.
So most of the time, there is a document that's already signed by the vendor to the person who's actually going to receive some sort of financial benefit, i.e. a commission, which would be the sales agent. It should only be the sales agent. And then from there, the conversation might come to us. But a lot of the time, the conversations might be quite fluid in the saying, hey, I know this particular person may sell at this price. I don't necessarily have the paperwork yet. However, happy to have a discussion, and we would then go away, take that information, draft it up, figure out, yes, we'd be a buyer at this, and that conversation might flow further to a purchase in the coming weeks and days.
I reckon we'll get you back on the podcast at some point. We'll go
There's
deeper.
A lot more to it.
It's a lot more in it. I just wanted to cover it and make it a point. So this particular property here that you secured for Alex was off market. There was no real estate agent involved in it.
Which was a benefit this is where the benefit comes too, is that no agent involved. There's no commission for the vendor to pay. There's no marketing for the vendor to pay. There's no additional work or holding costs, etc. So the reality of that situation is that they perceived there was value in selling off market because they had to do it quick. They're going through a divorce. They just wanted the paperwork and the signatures basically done and dusted because they didn't want to go through it anymore. And in light of that, they knew that they were saving, call it 1%, 2% of $1 million. There's probably, after marketing, is probably 25 grand in savings on their end, which we weren't paying for. They weren't paying for. Ultimately, they just didn't exist. So they come back to us as a benefit as the buyer, where you essentially discount the property by that amount straight up.
So genuine win-win-win scenario.
That was the intention, yeah.
And no doubt a big catalyst for this. We'll get into the mechanics of the property. A big catalyst of this was, it sounds, speed. It
was everything. And to Alex's point, and probably the reason why Alex was the person to buy this property, was speed. And the conversation came exactly like that via a text message.
And recklessness.
I'm not going to say that, but you can define it as that. But
maybe he's a bit reckless in who he chooses as his buyer's agent. But
I seem to be copping all the flack here.
You should do.
Yeah, fair enough. But to be fair, in this market, and it's a tough thing for myself personally to coach a lot of my clients through, is that I try to express it over and over, is that speed in these types of markets is everything. But to that point, Alex made a decision on a property within literally 10 to 20 minutes, but he wasn't assured of everything else happening in the background. I know Alex will probably elaborate on that a little bit here.
Look, I was just going to say, Paul, I've got so many friends, as we all have, as I'm sure everyone tuning in has, who talk about buying property. And I've got so many friends that talk about it and then they're waiting and then the market moves a little bit and then they go, oh, it's moved a little bit too fast, I'm going to wait a little bit longer. And so, I think being decisive, having the courage to move forward and having the right partners to help you, sort of make those decisions, a good mortgage broker, in my experience, a good buyer's agent, and maybe, sort of a conveyancer or, one or two other people, but having the confidence to move forward and not delay, with the support of a good team around you is critical. I think people just delay too long. And look, with this property in case, and it's been probably the best purchase I've ever made. Even if it had gone on market, it would have been more, but I still have made good money by just being decisive. You put the property in front of me and making that move and buying quickly has been sort of very, very beneficial.
If you speak to any property investor, and it's pretty much what I do for a living is speak to property investors, and some of them are pretty new to the game and others, you both included and other people, have quite significant portfolios. And you ask any of them what you would have done differently if you had your time again. Most of them would say exactly what you spoke about. I wish I was more decisive. I wish I said yes more often. I wish I bought more because I could have bought more. And everyone's always got an excuse why that didn't happen. But I think it's definitely a mindset sort of that you need to adapt of, you've got to be open-minded. If you are ready to go, you are prepared, you've got your finance in order, you've got the capacity, you've got the deposit, just be in market, and they're probably the clients that you like working with best.
They're the best. And they typically, unfortunately or fortunately, they usually have already got previous experience and usually they're not necessarily battle scars per se. They're
got scar tissue though.
But they also are aware of what makes sense and what doesn't make sense and what actually makes money in property and what doesn't. And you made a mention earlier, Alex, in the sense that you've never held a property too long, which is one of the things which you most of the time will never find a property investor saying, my mistake was I held the property too long. If you're holding it, you know that it's going to work over time as long as you can afford to hold it.
I think it's something else also interesting to point out, Paul, in this instance, because of the market and because it was a great buy that you put in front of me, this property has grown in value very, very quickly. But everything is like kind of time related. So, it just means I've purchased this property at a point where there's accelerated growth. But I mean, I could have bought it, 3-4 years previously and I would have seen no growth whatsoever.
Absolutely.
So if you take it over a longer time frame, things even out. You get X amount of % growth over a longer time frame. So look, great timing, great opportunity, but holding property for the long term, but being decisive. If you're decisive at a time when the market is moving quickly, you can get a chance to get some really good short-term returns. Now, what does that mean? For me personally, it means an opportunity to leverage off that equity more quickly and to grow my portfolio, and expand it above and beyond.
So this is true then, there's opportunities in any market, you just need to know where to look, Paul.
As always.
So do these opportunities pop up very often, or is this an absolute cracker?
I absolutely think this is it's a gem of an asset. And I think to Alex's point, this is going to allow, I think in your portfolio, Alex, whether you choose to use the equity that's already sitting in there to reinvest now or to do it at a later date, it's something that's already pretty much banked in. And the beauty is that we just did some quick numbers. It's basically cash flow neutral from day one in the Sydney market, which is also something which is going to be quite rare and will allow you to increase or not hinder as much your borrowing capacity for further assets as well. So, yeah.
Yeah, and I guess one of the privileges of me doing what I'm doing is I break one of the common tenets around it's rude to talk about money, but I think we need to talk about money. If you guys are happy to talk about money, I'd like to get into the mechanics of the deal. We'll just go to another break. Stay with us, back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyer's agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Paul Glossop. He's a buyer's agent from Pure Property Investment. Alex Whitlock, property investor extraordinaire, says yes when most say no, and therefore he's able to get these good deals when they do arise. And it definitely is a mindset shift. And we speak a lot about mindset on smartpropertyinvestment.com.au, and a lot of the conversations I have on this podcast is around that. So you can expand your mindset at any given time. We write about it, smartpropertyinvestment.com.au. Go and check it out. But let's talk numbers, if you're happy to talk numbers, Paul. So we're buying a property in the Sydney market in February of 2021, just as we'll start to emerge out of the depths of COVID-19, even though we're still smack bang in the middle of a pandemic. Let's not discount the maturity of that. Melbourne is still in lockdown. It comes out of lockdown tomorrow. It goes to show that we can go in lockdown at any given time. There are still challenges in small business. There's still challenge with people trying to make ends meet, but there is opportunities in any given market. So a February exchange, was it? Tell us about the deal.
Yeah, so I guess I've already given the preamble to the reason why these people were selling off market, and there's 2 other properties that we bought for 2 other clients which have done equally as well in different markets. But the reality is that we had this exchange between Alex and myself. In the background, I was working on this property as part of an off-market acquisition on a couple of other assets. We hadn't had it finalised, but we were very, very close.
Sorry, just to stop you there. So how long have you been thinking about this client of yours saying, hey, I need to shift this asset? How far between that and that conversation with Alex was there? Was it like days, weeks?
Yeah. It was probably maximum a week. Okay. So we spent about a week going through back and forth of negotiations on price to get them comfortable to say, yeah, we'll sell at that price. Once we got that, and what we typically don't try to do is waste our clients' time talking about a property until we know we've got the property secured at a price, because ultimately off market doesn't mean anything unless it's value. And our position is on market, off market, pre-market. Unless it's value, we're not buying it.
So you had the intent from the vendor to say, yes, I will be selling this at this price. Can you hurry up and find someone for it?
Pretty much. Yeah. Well, I said to him, look, if we can have it at this price, after obviously multiple rounds of negotiation, it was at that point I said, we'll have a buyer. It's done deal. And then not more than days. Okay. That was when the correspondence with Alex.
So tell me the price, son.
So I
guess.
What
was that from? Carpet.
Yeah.
Something to do with carpet.
Oh,
tell me the price, son.
I digress. You've got nothing to this.
You carry on, boys.
This is early 90s.
Yeah. Way before my time.
Tell them the price, son.
Tell them the price, son.
It was a father and son on the back of a...
Selling carpet.
They were selling carpet.
Yeah.
Carpet call?
Carpet call.
Well,
anyway. If you know what it is, let us know. Enter at smartproinvestment.com.au.
They've just got some really good...
Tell us the price, Paul.
So the property, I won't give the address, but the property's in Engadine in New South Wales.
All right, where is Engadine?
So Engadine's what I would deem to be primarily an owner-occupier-centric suburb in Sutherland Shire of Sydney. Okay. You're pretty much bordering National Park, really nice area. You probably...
So have you ever driven to Wollongong from Sydney? You've gone through Engadine?
You've gone through Engadine, yeah. Well before the Heathcote McDonald's, if anyone relates to that.
There's an Engadine McDonald's though?
There is an Engadine McDonald's on the Princess Highway, yes correct.
Yeah,
so there's that, there's a whole bunch of other things. Actually a big suburb, and it's on the train line, direct access to the Sydney CBD. A good market though. It's always been resounded as a good owner-occupier area, good schools, access to lifestyle, all those types of things. The property that we secured, eventual price was $930,000. It's a 4-bed, 2-bath, 2-car garage. That actual property now...
Like red brick?
Is renovated, but originally, I don't know, it was red brick from memory. I don't know if it was
trying to get
rendered. I'm just trying to bring up pictures.
Yeah.
But no, it was red brick, but it was a bit
like
of a facelift.
Classic suburban house.
Yeah, correct. And effectively, $930 was purchase price, but it was tenanted, mid-7s a week, which... When you're looking at close to $1 million at probably around about that 4% gross yield, the property borrowing full borrowing costs plus stamp plus closing, it was about cash flow neutral. So that's all good and well in isolation. You say $930,000 in Sydney, for some people that sounded like an awful lot of money, but it was at that time.
It's below the median.
Well below the median. I think median...
It's 1.1 at the moment, I think.
Yeah, 1.1, so well below the median. But this was obviously 3 or 4 months ago. And that market...
Probably was a median then.
Was going through a pretty big growth cycle at the very early stages of it. And that was where we saw, look, this is opportunity. It wasn't that the property was worth exponentially more at that time, but it was avoiding competition. Because it was one of that scenarios where if you go back through auction clearance rates in Sydney, February, March is when it was absolute fever pitch. You're talking it was close to 90% for a good month there. And this is the type of property that at auction, yes, it might have only sold at a private treaty of mid to high 9s, maybe $1 million. But at auction, you could have basically said, look, I wouldn't be surprised if it sold for 1.1 or beyond at auction, because it was at the time where things were literally ridiculous. And this comes back to here and now where we are mid-June and we've got a valuation on the property at effectively $1.3 million. And we have a penny drop moment there, but that's a $350,000 difference. We only settled on this property less than 2 months ago.
And is that purely because the March quarter was the biggest ever growth in property in Australia's history? Is that that's done all the heavy lifting there? Or has this moved faster, or is it purely under market?
I think it's a combination. I mean, look, I think we probably bought, and this is transparency, so the person who sold us this property is listening, they'll know this. At the time we bought the property, I think we probably bought it probably about 40-ish grand below what technical market value would have been.
If you gave it to a real estate agent and said, go out and sell it.
Yeah, correct. Because obviously they weren't just selling it at no price.
Which would have taken 6-8 weeks maybe.
Absolutely. And marketing costs, and ultimately speed on their end was important too, because again, they were going through that process.
And stress as well is a key thing. Absolutely. You know, like, I mean, we've all sold properties as well as buying them. It's a miserable time of your life, particularly if you've got other complicated, even if you don't have other things you're dealing with. Selling property is miserable. It's very, very stressful. It's more stressful than buying it.
Especially when you're going through a separation. I mean, you look at the compounding effects. So we were trying to be a solution for them to part ways with a whole bunch of things, which included them saying, look, yeah, I agree, we're not selling it at the top end, but we're also saving 2% on a commission, 5 to 10 grand on marketing, holding costs of another 2 months, hassle and stress with it all, going through all the hullabaloo. And the property was tenanted as well. And unfortunately, especially when it's a very owner-occupier centric area, if you're going to take it to market, you're technically going to really get the maximum if you made it vacant, prettied it up, styled it, which in turn they didn't want to do. The tenants were on a periodic, but they were looking to sign on an extension, which I know they've already signed on, stayed on. So the property didn't present well. So they couldn't sell it to an owner-occupier unless they booted the tenants, which meant there was another few months that had to go through to get that. So essentially there was a whole bunch of things which led to our favour to say, we're just going to buy it as is. We're going to absorb the tenants, and essentially those tenants are still in there. And it's sold onto a new lease.
So can you tell me, because normally what would happen is that if anyone's bought property before, a real estate agent would sit in the middle and they would orchestrate the sale, you'd sign a contract, blah, blah, blah.
Yep.
So who did all that stuff as part of this?
We did.
Okay.
Yeah. And obviously in conjunction, pure property investment.
Okay.
Yeah. Myself, my team, as well as our isolated conveyancers to make sure that we were making sure that the seller, we had to make sure we teed them up with.
So you had to do all the documentation
everything,
around it,
get them introduced to a separate solicitor. We had to need our solicitor. They couldn't be the same people. There was a fair bit of finagling there.
Yeah.
It's superb buy. It was, I guess it wasn't a vanilla purchase though, from my perspective. When we chat about it, Paul, I've worked with you for many years. I could see the opportunity. I could see the way, I've been in property long enough to know the way that growth was going. The challenge for me was finding finance. And yes, I got the deposit. That was okay. I've got the income, that's not a problem. But being a business owner, my tax returns weren't complete. So it's a huge challenge for me as a borrower. I saw the opportunity, but actually getting this finance was a real.
Well, I was going to actually ask you about
pain.
finance. I was setting this up to get into that. So, what 970 grand, 930 grand. So, what sort of deposit would have you had on that?
I think we went down the pathway of 10%, did we?
No, I went 20%.
20%. Yeah. So 20%. So
again, because of the challenges that I've gone through to financing.
Right. Yeah,
unfortunately, I was in a fortunate position where I could access that money.
Yeah. So it was a couple $100,000 plus. It was probably best part of $250,000 in access to equity / cash to actually get the deal done.
Yeah,
which was a part which, as you said, wasn't necessarily the challenge.
It's probably worth throwing in it. So the reason why this conversation, occurred in the first place is I'd got a dividend payment, which my accountant was saying, look, you need to do something with this, it was actually a little bit less than that, but with a few other bits and pieces, I was able to scrape it together to make this purchase. So that was the genesis of this opportunity.
So tell me about the financing then. What lender did you use? What sort of structure? Did you buy this in your personal name? Tell us about all this stuff.
So obviously, Phil, you and I have got a sort of significant portfolio between us, the Smart Property portfolio. This is something, and you and I both pursue our own investments outside of that portfolio. So yes, I bought it in my own name. I didn't want to have the complications of going through sort of the trust structure and so forth. Once, talking to Paul, talking to Munzer, it was very, very clear that this was a good opportunity. Had a look at the data for that particular area, could see that it was already starting to move and that there was the potential there for further growth. So then the biggest challenge was finance. I've always used a mortgage broker. Mortgage brokers are aligned with my objective because they get paid a commission when my loan is settled. So immediately I know that my broker is going to be very much aligned with the right outcomes for me. But that's kind of only really the start of it. Because my situation is complicated, Phil, this is not a vanilla deal. It's not like walking into a bank and going through a PAYG, straightforward, nice vanilla deal. Even though it was an 80% purchase, it was still complex. So I had to go down the low documentation path. But also because of because I've got a lot of properties in my name, it wasn't, again, still straightforward going down the low doc path. I'm pretty heavily leveraged, both through our joint portfolio and also through my own investments. So I use a broker called Finney. Basically, I use an investment specialist because being an investor, I needed somebody who understood not just investment properties, but generally the kind of DNA of an investor. And typically they've got multiple properties already on their name. They're often self-employed or have a more complex structure. So it was, and I can tell you it was touch and go. And it went, again, because I've got confidence in purchasing, I didn't get nervous going through, but this went, getting my final unconditional approval ran to probably 2 days before settlement. But the broker knew exactly what the challenges were going to be. They use a non-bank lender. So for those of you tuning in, as well as the high street banks and the non-major banks, there's also an array of more specialised non-bank lenders. So they chose a non-bank lender. Better Mortgage Management is the company that they selected, who worked tirelessly to get the deal through. And look, the outcome was I purchased the property. I got it. The interest rate was a little bit higher. I've got an interest rate of just over 4%, 4.5%, which, in today's market is higher than your standard vanilla rates. But for me, and again, you got to look at the overall picture. Paul had found a property that had great potential in terms of growth. The cash flow was very, very close, near on neutral. I was not really too worried about being bang on cash neutral. So for me, in my situation, paying a higher interest rate to get an incredible capital growth opportunity was well worth it. And I can look to refinance again further down the track and bring that back in line.
And this is the difference, Alex, I see, and I chat to a lot of investors, between someone who's new to the game and someone who's a more sophisticated investor. You've seen a lot.
Nothing
where you're going.
about me, Phil.
I was trying to give you a compliment, but obviously,
I'll take it.
But and I had a really good chat. And if you haven't listened to it yet, everyone, I had a really good chat with the head of product over at Bluestone Home Loans just the other day, and we spoke about some of these type of products they have. That's another non-bank lender. We actually had a discussion around non-banks and why people sometimes use non-banks. They're also a prime lender, right? So, if you're a PAYG person, they'll sort you out, but they look at deals differently. And you see that sort of philosophy from a lot of non-bank lenders is that they just don't have a credit score or anything. They'll look at you as, someone who's a more holistic.
There's much more human element to it.
Yeah, and when you start getting large portfolios, it does start getting a lot more complicated. So, you might be paying 4.5%. You're talking about this probably being positively geared. So, you're happy with a negative geared scenario. So whether you're paying 4.5% or 4%, it still washes out at the baseline position for this particular property.
It's a really, sort of curious aspect of investment. You've got to look at what the cost of debt is. But I think sometimes investors and home buyers can get a bit of a disproportionate sense of the actual sort of the interest rate. And it's a big thing, Phil. I think in terms of working out suitability of a product, I think everyone is encouraged to look at the interest rate, but really it's only a very, very small aspect of, what makes a product suitable. Of course, the interest rate has to be within the ballpark because it does, ultimately affect if you're a homeowner, it's going to affect your flat repayments. If you're an investor, it's going to impact your cash flow. But it's really about, can I buy the property? Is the product going to suit my needs in terms of its flexibility? How quickly can it be approved? And then does the interest rate stack up? So it's part of sort of a whole proposition.
Yeah, and if you are new to investing, or even if you're looking to build your portfolio, it is a game of finance. Absolutely is a game of finance. And if you look at any advert on TV or in the papers at the moment from any home loan lender, they'll be marketing on how cheap their rate is. But what you need to remember is that those super cheap rates, Paul, and you probably see this all the time, are the ones that have very little features connected with it. So if you want offsets, if you want redraws, if you want, all these different tools and features you can have to shape your investment, you need to think of it and you need to consider it. So speak to your mortgage broker. They'll be able to steer you through that. And there's literally hundreds, if not thousands, Alex, of mortgage products out there.
Just on the topic of offsets. So I had an offset attached to my home loan, and I'd sort of put an effort into up my repayments to go into the offset account, which I'd done sort of just as a sort of out of sight, out of mind type proposition. So it was not in my sort of current bank account; it was actually with a lender, so I didn't see it. So I actually got quite a bit of money saved up in my offset account, which I'd set up on my home loan, and that was really having that there because that's what really got me over that gap to be able to get the 20% because I didn't have 20% to hand.
So again, this is quite tactical, but were you paying off your home loan, paying a little bit more every month? Is that how you build
I was,
up the offset?
And as you well know, there's no tax deduction on your own home. Now, interest rates are low, but nonetheless, it was a two-pronged thing, Phil. First of all, it reduced my interest rate on my home loan. It also was, by default, a good little war chest, should I need to tap in. And there was a bit of a twang when I saw that go down and my home loan went up. There's that, because it's not money for jam, right? It's still... it still affects, rather than being an early repayment of your home loan, it's offset. But, looking at this opportunity, it allowed me to move quickly. It allowed me to move with confidence. I knew I was going to have to, jump quite a big gap in terms of getting the right finance to make this opportunity take place. But being able to hit that 20% deposit really was a huge enabler because going any higher than that with my low doc structure was going to be very, very difficult. And it was really down to sort of one or two lenders anyway.
Can I just make just one comment on here? And this is something that from my side of things where I talk about it till I'm blue in the face, and I probably have 20, 30 meetings a week with either prospective investors or potential investors who have got multiple properties in their portfolio and looking to do more, or maybe even having a conversation to say, I've hit the roadblock at the end. And their definition sometimes is why I can't do any more is the definition as to why you said there's a solution. It's just more expensive. And it all comes back down to the two words of opportunity cost. And so often it's bandied around saying, what's the opportunity cost? For you to say yes, and then essentially take a 4.5% interest rate, which on $1 million in total lending, which basically is after closing costs, et cetera, $5-7 grand a year difference in a standard lower more mainstream option, which could have been available if you waited to end of financial year, did your finances, etc. Maybe let's say five months down the track. We've just demonstrated that
it's a rounding of a decimal point. You know, you put that in context.
We're talking 350 grand difference in a property outcome on one decision point in time, which can be refinanced to a cheaper rate in the next 6 months anyway. And so often people they don't look at that as my end goal. Is that what does it mean by me saying no or me waiting till next year? If the market grows 20%, you trying to save 0.5% on interest rate is going to potentially cost you, in your instance, would have cost you 300 grand on a decision which you wouldn't have made.
In broad brushstrokes, I've got a 4.5% interest rate on a loan that's around about 750 on a property that's worth any day of the week 1.2, maybe 1.3.
Yep.
That's what it's come down to.
That's the difference.
And look, I know we're sort of talking about this quite rapidly, and some people might be scratching their head going, "Oh, I'm not keeping up with this." So, this is when we start talking about the tactical elements of being a really effective property investment or property investor. So, smartpropertyinvestment.com.au, there's lots of stuff there, but also speak to your accountant and your mortgage broker. They can run you through how all this sort of stuff works, because starting to go, well, I'm paying away $7 grand to make 300 grand. I reckon I could put that deal in front of any property investor and say, would you do this? Yes or no? 99.9% of them should say yes.
But you'd be so surprised at how often people can't see past, but it's a 4.5% interest rate.
Or will shop around for a different lender to try and save themselves.
And the opportunity's gone. Yeah. Because again, this decision was made in, not to say you expect them to be made in 15 minutes, but this would have had to be made probably in a day. So for them to go off and say, I'll wait till I get my finance right, that deal's gone.
And back to my chat the other day with the head of product at Bluestone Mortgages, he was telling me, Alex, that they will turn around a deal in 48 hours. 48 hours. And I've been thinking about this a lot recently in terms of how, as a property investor in particular, but homeowners are still relevant, is that the speed for decision making, confidence around decision making, trumps always the interest rate, right? If I go directly to a bank these days, it's taking me quite some time to even get a decision whether or not they'll lend me money.
This was going to say, I think you're hitting on something really important here, Phil. So let's unpack making quick decisions. If you make quick decisions without knowing you've got the right support mechanisms around you, then that is reckless. I make light of it. I'm not reckless. I just move quickly. And having a mortgage broker, but not just any broker, having a broker that understands and specializes in investment property and, more importantly, in investors is critical. So look, I got the 20% deposit, but I knew that finance was, even while I was texting Paul, I knew finance was going to be tricky. I was with my accountant who knew it was going to be tricky, but I knew that it could be done. So I think understanding the speed of a decision, if you have got finance, is critical to every purchase. It is finance that makes you your money, as well as having a good buyer's agent, having a good opportunity. It's the financing which is the real enabler. So knowing that you've got a financer that can move and act on your behalf, it makes the speed of decision making so much easier because you've got the confidence.
Well, it means you can make decisions.
Well, it does, yeah.
That's what it is. It allows you to say yes or no. And that's what this is all about, being able to say yes and no. So you've got to say yes. If you've been in this for a while and you've got a good mortgage broker, you should have a relationship where they know your business, they know your makeup well enough so they can go, say yes because we can sort it out. Might be a bit hard, and we might need to sort of be a bit creative in how we go about doing, or speak to some particular lenders. There's a raft of lenders out there.
Absolutely.
But if you can get a decision quickly, it enables you to be a better property investor. It's all really exciting stuff. Did you fix or variable on your home loan?
A topic for another lengthy podcast, but in this instance, no, I've stayed variable.
You're on variable.
Yeah, and look, I'll look to refinance.
And interest only.
I've gone interest only, yeah. I'll look to refinance at some stage in the future. Look, I'm happy with the interest rate being where it is. Like, Better Mortgage Management, they worked hard to get this loan secured for me, so I'm going to let it sit there with them for a while. But I will refinance. Look, I'll look to take out the equity that we've already achieved. What it comes in at when we get an actual val will remain to be seen, but it's certainly going to be significantly more than I purchased.
If you can dredge a couple of $100,000 out of that in terms of equity, you've got some scope there and some parameters. But I'm getting a lot of questions, guys, on smartpropertyinvestment.com.au most recently, because people are getting frustrated with finance. They're really trying to understand how the finance works, particularly for property investors. They're out there getting pre-approvals and stuff and not finding a property. There's a fair bit of information around there. So watch this space. We're going to do a big deep dive in financing for this next period running up to the end of the year, purely because you've got to be armed and enabled from a financing position to be an effective property investor. If you've got any specific questions around finance, editor at smartpropertyinvestment.com.au. I'll get some people on and we can answer those questions directly. We can get as technical as you want, or we can be 101 if you really want to go that pathway. But it is a lot of questions I'm getting right now, so watch your space. So what's next for this property? So just sit there and
Let it do its thing. Look, I've already seen, very fortunate. Timing is a great thing. Timing's been fortunate to me. It's already gone through quite a lot of growth. Experience tells me that it's not going to carry on growing at the velocity that it's grown now. It'll just sit there. It might go up a little bit further.
Yeah.
Let it sit, let it settle. I've already, made a great purchase. I will look to make another purchase sometime in the future. Look, I've got that. Plus, Paul's also helped me, secure a number of properties. Look, there's a couple in New South Wales. There's 4 up in Queensland. So, look, we're already chatting about what we do to maybe look at doing a development, knockdown rebuild on maybe one of the larger blocks, got an 800 square metre block in one of the Queensland properties. So, it just creates opportunities, Phil, and for me as an investor with 6 in the portfolio that I've got, on myself, you and I have got, 19 in our portfolio. We've got a lot of opportunities there. Just means that we can start to look at going beyond buying, sort of the usual sort of single dwelling places and now start to look at maybe going into some sort of developments and doing something maybe a little bit more adventurous.
Okay. And Paul, I'm going to give you the opportunity to give the headline for this particular podcast. What's the top line summary for you?
Don't let opportunity cost you.
There you go. Don't let opportunity cost you. All right, that's not a bad summation. Think about that. You're probably, for our listeners, sort of working on something right now, and keep the opportunity at the core. Don't get caught up with the noise around it, because
there's so much we could talk about here, which excites me like no one's business. Talking about all this stuff, I just like there's conversation on conversation here.
We haven't spoken about it, but do you cover all this sort of mindset stuff in your book?
I do actually.
Yeah, you do. Yeah.
Surfer's Guide to Property Investment. I do. I actually literally have that definition of opportunity cost. So we have a chapter all about that, as well as all about mindset. And it comes down to all these things we're talking about. Maybe it's another time,
How do you
another
get that
discussion.
Book?
Purepropertyinvestment.com.
Okay.
There's an order now button that goes straight there. Jump on the homepage, you can order it. I think you just pay for the shipping. I'll cover the book and it'll be in your house in typically a week.
That's pretty good. Can you still get in the bookstore?
Absolutely.
Yeah.
And online. Wow. Anywhere online.
Wow.
It's a bestseller. 8,500 copies sold.
When are you going to do an update for this current market?
When you're prepared to write me another forward, Philip. Because that took about 6 months for you to write one very small page.
But look at the quality though. Look at the quality.
Yeah, exactly. That was the problem.
That's the reason why it's a bestseller. Because that's what people read first, right? They go, this actually sounds
Don't need to
right.
read the rest of the book now. Put it back on the shelf.
Yeah. I'll go
We're going to leave it. No, gentlemen, thanks for your time today. We've covered a lot there. And as I mentioned, if you're sort of sitting there scratching your head going, what do these guys just talk about? I get it, because some of those terms are a little bit complex. Go to smartpropertyinvestment.com.au. We write all about it. And again, happy for you to follow up, editor at smartpropertyinvestment.com.au. Now, one favour for me, it's just not myself here behind the microphone. We've got a real talented team of podcast producers here, and they get a real kick out of those reviews. Whichever podcast player you're tuning into on this right now, if you can leave a review, some comments, a 5-star if you think that's what we're due. I get a real kick out of it. A real favour to me if you could do that. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Bluestone makes investment loans simple with competitive interest rates. Borrow up to 85% of the value of your investment property without paying lender's mortgage insurance, and no cap on existing investment portfolio size. Plus, personal Bluestone support from application to settlement. So don't wait to unlock your future. Bluestone, award-winning home loan solutions. Find out more at bluestone.com.au/investors. Lending criteria, T's and C's and fees apply. Credit provided by Permanent Custodians Limited, Australian Credit Licence 390183.